And I mean, I think the key is you can understand why it would mirror the financial crisis in that look at what interest rates have done, and even just with what they did to those regional banks. I mean, then you throw in the commercial real estate issues, and I know everyone remains so bullish on residential real estate, but I'm in the opposite camp here. I think that there's this false sense of security because there's not a lot of supply on the market. But if you get any sort of situation with interest rates on the 30-year where people are taking mortgages and paying 7% with prices of homes where they are, and I think there was a stat on this. I saw a chart on this too. I don't remember who posted it, but how expensive, how much income, I think it's 40% of someone's income is now going towards, on average, towards housing, whether it's renting or owning. And that is the highest historically that it has ever been. And think about that, folks. Think about it. 40% of your income is going to housing. And let's say one person in a household loses a job. What's going to happen? You're going to see a massive spike on mortgage defaults. And in fact, I think this was another chart I saw as well, is that it was talking about delinquencies. And I think we are even above 2009 levels on delinquencies. Now, again, I don't want to be all doom and gloom here, but I do want to just kind of counteract the mainstream medias and really even a lot of players out there that are analysts in terms of saying that everything is perfect, no problems, we're going to have a perfectly soft landing. I do want to give a different perspective so that people can make an informed decision. This is the kicker, is that it really depends on how bad things get. And to be honest, I'm not good enough to know that. But what I do know is that we have levels that, again, you can see again how we're back to this trend line. If you take this low from 2020 and you put it right through, that's what we're hammering on right into this area. So we are to a lot of resistance. Now, there's two scenarios for the S&P. One is we stall here and we roll over, which would mirror the 1929 to 1930 period. It would mirror the dot-com period, as well as 2008, 2009. The other scenario could be the Bitcoin scenario, right? Where Bitcoin had that big middle dip and we made a slightly higher high before rolling over. And again, in both cases, there's issues for the market. One just happens to be much more overbought, which usually means the downside will be much more dramatic. What I do think, though, is that at minimum, we're going well below those October lows. And I think the two levels that I would watch closely is this pre-COVID line right here. And this is kind of like the mild recession scenario where inflation is not really that high, but we're just kind of stuck in this mild recession because the Fed can't print us out. And that would be right around this 32.65 level, right? If you get in a bigger issue, there's a secondary line here, which we can connect here, which is around that 3,100 level. So these would be the two first areas, and notice how they're converging, which means it would be major technical support in this, let's say, 33 to 3,100 level on the S&P. If we want to talk about the catastrophe side of things, then you're talking about revisiting this area down here, which I hope for all of our sakes that does not happen, because if that were to happen, I would hate to see where the economy is at that point. The only reason I bring this up is that if you look at charts, there's a tendency for charts to do what we talked about earlier, which was a retrace to the scene of the crime, where you have a double top here, and you break out, and then you retrace down to it. Because of Fed intervention in 2009, right, and the quantitative easing that went on for so many years, the markets never were able to naturally retrace to retest that level. And the question then becomes is, does at some point in the future, does that have to happen? I hope it doesn't. I hope this is our base case here, but just be aware that if we got a really bad recession, let's say we get stagflation. So we get a bad recession with inflation elevated and the Fed isn't able to print us out of it. That would be potentially the target down there. Scary stuff, really.
Binance and its CDO are planning to file a motion to dismiss the Commodity Futures Trading Commission lawsuit against it, according to a new court filing. Meanwhile, Coinbase's chief took to Washington, D.C. last week to talk to lawmakers, and the proof-of-person project WorldCoin has launched its token. Coinbase CEO Brian Armstrong believes United States lawmakers are pursuing crypto regulations with a new sense of urgency following Ripple's partial victory in its lawsuit with the Securities and Exchange Commission, SEC. The bullish momentum that propelled Bitcoin to a 76% year-to-date gain all but vanished on July 24 as Bitcoin price briefly fell below $29,000. The contraction in Bitcoin price has some analysts cautioning that BTC could still dip to $19,000 in a serious shakeup. Crypto traders turned briefly bullish when the Federal Reserve decided to pause interest rate increases on June 14. But on multiple occasions, Fed Chair Jerome Powell has expressed his commitment to reducing inflation by restarting rate hikes if needed. The next Federal Open Markets Committee, FOMC, concludes on July 26, and the market seems to confidently believe that the Fed will begin increasing interest rates again. CME's FedWatch tool shows the overwhelming market belief that such increases are coming at the next FOMC. As of July 24, the probability of interest rate hikes sits at 98.9%. Most major banks still expect the U.S. to experience a sharp recession at some point in 2023. According to U.S. Bank Analysis, which incorporates more than 1,000 data points, investor sentiment about the current state of the economy remains low. According to a U.S. Bank Analysis, our U.S. health check is hovering above levels consistent with historical recessions as the Federal Reserve, Fed, continues tightening monetary policy to combat elevated inflation. The short-term uncertainty in the crypto market does not appear to have changed institutional investors' long-term outlook. Recently, despite a hostile U.S. regulatory environment, large institutions are pushing for Bitcoin financial instruments, which may spark a bull run. Bitcoin price continues to be directly impacted by macroeconomic events, and it is also likely that further regulatory actions and interest rate hikes will continue having some effect on BTC price. In the long term, market participants still expect the price of Bitcoin to recover, especially as more financial institutions are seemingly embracing BTC.
My guess is you'll see the first little signals, and then it'll be like all in a flush. You'll start to see these numbers turn very, very quickly, because I do think that, and I mentioned this on the spaces earlier, is that there's this tendency for employers to say, oh man, during COVID, like I couldn't get anyone to work for me. It was so hard to find a good employee. I did finally get them. I don't want to fire them. And then if it's a soft landing, I got to rehire, right? So yeah, sales are slow, revenues are down a little bit, but I don't want to get rid of them. But if you get in a scenario where all of a sudden it's a no-brainer, like, okay, we're going into a recession, things are going to be tricky for the foreseeable future, that's where that wave of selling pressure comes in. And I did have that chart up before. Let me try to bring it back up here. That I just think is an interesting chart to look at. It's U.S. interest payments as a percent of GDP versus the Fed's ownership of federal debt. And look at the divergence here, right? So you have interest payments as a percentage of GDP skyrocketing, while the Fed, again, the ownership of debt is coming down. And I do think that's something we want to be aware of. It's kind of those jaws again, right? It's a divergence that at some point probably has to be remedied. But this week we will have, so after the bell tomorrow on the stock market, you'll have Google and Microsoft reporting. Then on Wednesday, the Federal Reserve at 2 p.m. will come out, and Jerome Powell will give his speech, his press conference at 2:30. The expectations right now, I think, 96% chance that the Fed hikes rates, or something like that, something crazy.
98.6.
90, there you go. So basically, folks, they're gonna hike by 25 basis points at this point. The question and what the markets will react about is their guidance going forward. Are they going to say, hey, we're going to take a break for a few months? Are they going to stay hawkish? Or are they going to potentially say, hey, we think, it's their commentary that I think will be very important for the market. So just a few things to watch in the coming days that are going to be very intriguing.